In continuation of our discussion on WACC, that is weighted average cost of capital, now we want to address cost of capital in a more specific way. So here we start with cost of capital through borrowing, debt financing, like loan that you get, like publishing bonds. When a firm borrows, it pays interest. That's a fact. When you share ownership, you are sharing the profit. But when you borrow, you should pay interest. The interest rate is the stated cost of borrowing. For example, it says 10%. But still wait, I just said stated cost of borrowing. But in reality, it is different. Because if the stated rate of borrowing is 10%, the actual cost is lower. So here, it should be better we rephrase this part in this way. The interest rate is the stated rate of borrowing. In that way, it would be better. So we are going to discuss on that. How come if the interest rate is 10%, but the real cost of borrowing is less? The answer is explained in this slide. Tax deductible expenses. When you have a tax deductible expense, tax law allows you to subtract that expense when you are calculating taxable income. So you come up with lower taxable income and you are going to pay less. And totally, it ends up in less expensive cost of capital for borrowing. Expenses that are not tax deductible do not reduce taxes, even though the firm pays them. So that makes tax deductible expenses important, because you pay them, but also they help you with paying less taxes. Let me give you an example. Imagine before applying a tax deductible expense, like interest, you have profit of 80, okay? Without interest, if the tax rate is 20%, you should pay $16 in tax. But now we go and apply a tax deductible expense, for example, interest here. Let's say it is 10. So the taxable income after applying that 10 would be 70. And when you apply that 20% rate of tax, you come up with $40. So after applying the tax deductible expense, now you are paying less tax. How much does it save you now, according to this example that I'm showing you $2. So here you are paying in your calculations, according to your contract, $10 for the borrowing that you have had. Let's assume the original amount of borrowing is $100. And on papers, they consider you pay 10% interest rate. So you are paying $10, as you can see here, on the 100 loan you got. That is 10%. But now you see it is not accurate because you are not paying $10 out of your pocket. The interest itself helps you to keep $2 more in your pocket. So in fact, you are paying $8 out of your pocket. Government pays $2 of that $10 for you. So the real rate of return, the real interest rate is 8%. We are gonna do more examples and exercise on this because it's an important topic in financial management. And in many cases, borrowing becomes the better option than sharing ownership just because of this tax saving, or in fact tax shield that happens. The reduction in the tax paid is an important number in calculations because it's the amount of money that you keep in your pocket. So we have a name for that, tax shield. And as you can see, the explanation here, a tax shield is the reduction in taxes paid. In the previous example that I showed you, the tax shield is $2. Without the tax deductible expenses applied, you paid $16. But after that, you paid $14. So the tax shield was $2. If I want to give you another example for tax deductible expenses, I would say depreciation. That we have already calculated the impact of depreciation on the cash flow, if you remember. But now you are getting more information about this field in a more technical way, as it is the style of our class, as I mentioned also before. I prefer to be holistic, first go for the core points, fundamentals, before we get to details and definitions. But now you are going to understand it better because you remember when we tackle getting the cash flows by applying the depreciations, taxes, or that type of thing, you got a good understanding of these things. And here you see the formula. As I have always told you, never memorize anything because the way we handled it quickly, it just was common sense. So no need for memorization of any formula. It says tax shield value, how much it save you value, the deductible expenses that you have. You are not gonna pay tax on them. That's it. So in the previous case, the deductible expense was $10 for interest rate and the tax rate was 20%. So the amount it saved us was $2. How we calculated this in this example, we said that before deductible expenses, we have 80. 20% of 80 is 16. And after applying the deductible expenses, we have 70. And the tax of 70 is 14. So how much is the shield value? 2. In this way, we are doing it in more practical way. And here you have the formula for that. But please never memorize anything. At least first understand them so they become part of your second instinct. And when you digest the concept very well, for the sake of speed and swift analysis processing, memorize the formula. Tax shield value is deductible expense, that is 10 times tax rate. But with common sense, you can come up with these things on your own. Now I have a beautiful example for you that I'm sure you would love it. And here we have two shops. They are pizza shops, and they both sell 200,000 of pizza per year. They are the same in that regard. And also the costs they have, operating costs they have, is the same for both of them, $120,000. We are not going to get into the details of accounting or that type of thing. We are handle this problem from the perspective of a financial manager. And the only difference between these two shops is that shop B got a loan to buy a new oven. And for that loan, they have to pay $10,000 every year. Stop the video and try to read the question so you can catch up completely. What are the situation? And then we are going to continue it together. Okay, the profit before interest, that operating profit that they have, for both of them are the same, $80,000. But shop B needs to pay also $10,000 for the interest. So the taxable profit for shop A is $80,000 and for shop B is $70,000. How much is the tax paid? At 25% of rate. So for this one, I have considered the tax rate of 25%. So the tax paid shop A is $20,000 and shop B is $17,500. So how much is the tax shield here? $2,500. Okay, that's a very important number we always need. But when you check the real profit, shop A still make more profit than the other one because it makes $60,000, but shop B makes $52,500. That makes sense because shop A doesn't pay interest. But the point is that sometimes get confusing is that without tax deductible, the profit of shop B would be $50,000. So that's the reason the real cost of capital when you are borrowing money is less than the stated rate on the contract, because interest is a tax deductible expense and provide us with tax shield that is considerable, and as I told you, in many cases makes us go for borrowing.